Peter Lynch once said that the average investor has advantages professionals often don't. That sounds impossible in today's world of AI, algorithmic trading, endless financial news, and millions of opinions flying across social media every day. But what if those very distractions are exactly why his advice matters more now than ever? If Peter Lynch were investing today, he probably wouldn't tell you to chase the hottest trend. He'd likely tell you to slow down, pay attention to the world around you, and remember that great investing has always been about understanding businesses, not predicting headlines. Peter Lynch managed one of the greatest performing mutual funds in history by focusing on a surprisingly simple idea: invest in what you know. He believed that ordinary people often spot winning companies long before Wall Street does because they experience products and services in everyday life. That lesson hasn't aged. In fact, it's become even more powerful. Think about your daily routine. Maybe you notice a restaurant that's always packed while competitors sit half empty. Perhaps a new payment app has become the preferred choice among your friends. Maybe a grocery brand keeps selling out because customers genuinely love it. These observations aren't investment recommendations on their own, but they are clues. Peter Lynch believed curiosity could become one of an investor's greatest assets. Today's investors are surrounded by noise. Every day there's a new must-buy stock, another market prediction, or a viral post claiming someone turned a small investment into a fortune overnight. Peter Lynch would probably smile and remind us that excitement doesn't equal value. He often warned against buying businesses you don't understand simply because everyone else seems enthusiastic. Imagine two investors. One spends hours scrolling through stock tips online, jumping from one popular investment to another. The other quietly researches companies whose products they actually use, studies their financial health, and patiently waits for attractive opportunities. After several years, who was more likely to build lasting wealth? History suggests the second investor has a much better chance. If Peter Lynch looked at today's fascination with artificial intelligence, he probably wouldn't dismiss it. Instead, he'd ask a different question. Which companies have durable businesses? Which ones generate consistent profits? Which businesses are priced reasonably rather than fueled by hype? His focus was never on owning fashionable companies. It was on owning great businesses at sensible prices. One of the biggest enemies of successful investing isn't a market crash. It's emotion. Fear convinces people to sell after prices have already fallen. Greed encourages buying only after prices have soared. FOMO, the fear of missing out, pushes investors into trends they barely understand. Peter Lynch repeatedly emphasized that investing isn't about having the highest IQ. It's about keeping your emotions under control when everyone else is losing theirs. Consider how many investors abandon strong companies during periods of uncertainty, only to watch them recover and reach new highs years later. Patience isn't exciting, but it has consistently rewarded disciplined investors. The stock market has a way of transferring wealth from the impatient to the patient. Another lesson Peter Lynch might emphasize today is that information has become abundant, but wisdom remains rare. Investors have access to earnings reports, analyst opinions, financial statements, podcasts, videos, and real-time news with a single tap. Yet having more information doesn't automatically lead to better decisions. In many cases, it creates analysis paralysis. Peter Lynch would likely encourage investors to spend less time reacting to daily headlines and more time understanding businesses over the long term. He also believed that mistakes are part of investing. Even the best investors make them. The goal isn't perfection. It's making more good decisions than bad ones over many years. That perspective removes the pressure of trying to predict every market move and shifts the focus toward continuous learning. So what would Peter Lynch tell investors today? Stay curious. Invest in businesses you understand. Ignore the crowd when necessary. Don't confuse popularity with quality. Be patient when others are impatient. And remember that wealth is usually built through consistency, not excitement. The market will always change. New technologies will emerge, new trends will dominate headlines, and new fears will replace old ones. But human nature changes very little. That's why Peter Lynch's principles continue to stand the test of time. If this episode gave you a fresh perspective on investing, consider subscribing for more timeless investing lessons inspired by the world's greatest investors. Leave a comment sharing the Peter Lynch lesson that resonates with you most, and share this episode with someone beginning their investing journey. Sometimes the greatest investment lesson isn't discovering the next big stock. It's learning how to think like a great investor.